Reasons financial planners are so busy at the end of the financial year, part 4. All right, so this one's all about making final pension payments. If you're older than 60, you can turn your super into an account-based pension or something called a transition to retirement income stream. Whether you're one of these accounts, you need to meet what's called a minimum pension payment requirement for the entire financial year. And that means working out throughout the year, well, what accounts have been created as a pension or a transition to retirement, what payments need to be paid out to make sure your super fund remains compliant. The tricky part comes when you've got a self-managed super fund, because you might be stopping pensions throughout a year, and you need to be able to calculate what's the right amount of pensions to be paid prior to end of financial year. So that's the whole funding part. We need to work out how much we're paying out. And the second part is, well, how are we making that payment? Do we need to sell assets to make that payment? Do we need to transfer assets to make that payment? It's all about keeping your super fund compliant so you can have the tax concessional rates within super. Now, if you don't know, anything in transition to retirement will still get taxed at 15%, could be as low as 10%. And in account-based pension phase, that is, you're older than 60, you've stopped work, or you're older than 65, minimum payment of 4%, typically the tax rate here is at 0% on any assets you sell. So it's up to us to figure out how do we get that money out in the most efficient way to make sure the fund remains compliant. That is part 4.